Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome back to Equity Mates, a podcast where we explore what is possible in the world of investing. If you've just joined us for the first time, a huge welcome. We have a massive episode for you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. I'm always excited to speak to you, and I'm also excited anytime we get to speak to our guest today, Luke Laretive, the founder and CEO of Seneca Financial Solutions.
Yeah. So, where do we start with this guy? Because you're either on his side or you're very much off his side, and I think that's what we appreciate when we speak to him, is because he definitely challenges a lot of the norms that we've learnt or at least come to understand in investing.
Yeah.
Particularly when it comes to letting your winners run and taking profits, or letting your winners run versus trimming, taking profits and just making a cold, hard buck.
Yes. Yeah. I mean, in both instances, you're trying to make a buck.
Yes.
It's the best way to do that, I think is the question. But yeah, there's a saying in investing, don't trim the flowers to water the weeds. And, you know, I think everything we've internalized as investors is really about like the power of long-term compounding returns in either the index or in high quality stocks. And we've grown up in an age of high quality compounders becoming $1 trillion companies. Like our whole lived experience as investors is find great companies and don't sell them. Makes a lot of sense. Alphabet, Apple, Microsoft, Amazon. There was no better investing strategy. But also like the best investors of our time have lived that strategy. Warren Buffett's story is a story of multi-decade time horizons and not selling despite what's happening in the world. And then like, even if you take it a step back here in Australia, so many of like our parents' generation, they just benefited from like the big floats of their time, you know, like the Commonwealth Bank and CSL and BHP was a float from before their time. But like, again, just this like let your winners run, buy quality, let it compound over time is a strategy that's done very well. And it's not just like anecdotal stuff like that. I like the research backs it up as well. Yeah,
you're right, Ren. So there's plenty of research to show that over trading can actually be hazardous to your health. And your wealth.
And your wealth, yeah.
Can be hazardous to your wealth and your health. Now, there was a UC study back in 2000 conducted by a couple of researchers to actually try and illustrate this. And it showed that over a 5-year period where the market returned 18% annually, those that traded frequently or overtraded only earned a return of 11%. So a pretty significant difference there, and just goes to show that overtrading can actually seriously impact your returns.
Yeah, Morningstar every year publish their Mind the Gap report. Similar thing. It looks at the index, then it looks at the average return for the investor in that market. And the same story plays out that people overtrade and it diminishes their returns. I think the most recent report for Australia, the Australian investor was about 5% down from the index. And that was because of trading. And S&P Global, they do their SPIVA scorecard, which we've spoken about before, that talks about active managers and how few active managers outperform the index. And there's this perhaps apocryphal, no one knows if it's true or not, Fidelity study, which is now known as the Debt Investor Study, where Fidelity looked at their best performing client portfolios from between 2003 and 2013. And what they found was that a number of their best performing clients were dead.
Meaning they weren't trading.
They didn't touch their portfolios. And so that's what we've been told. And that's what we've grown up learning. And that intuitively makes a lot of sense. And even the best companies have periods of drawdowns, periods of being overvalued, but the best companies power through over the long term. So that's the conventional wisdom.
Yes.
Luke Laretive is unconventional.
He is. He challenges the views, and that's what we love about him. And so in this episode, we really get a sense of that, because he is not all about letting all of your winners run. He will trim that rose bush, drive over it in a mower.
If it can add a basis point to his return.
If it can add a basis point to his return. So, we get a sense in this interview of what he thinks about conviction and I guess portfolio construction and I guess valuation, because he's one where it hits that valuation metric or his thesis is broken. He is out and looking at where else he can deploy that money.
Yeah, I think what we've learned over the journey is there's not one way to make money in the share market. There's a number of people that have a number of different strategies, and a lot of them find ways to make money in the market. And so we love hearing people's different points of views and different ways of making money. And Luke certainly has a point of view. And based on the returns of the Seneca funds over the past few years, which you can see online, he certainly has made some money. So it's always interesting to hear from Luke, and I think this has got me thinking a lot about some of the stocks that I've held for a while and have done quite well on, but are perhaps teetering on the overvalued or very overvalued territory.
So in this episode, we're going to go through some of the stocks that he's bought and sold in his Aussie shares fund and also the small cap fund.
Let's do it. Luke, welcome back to Equity Mates.
Bryce, Ren, good to see you.
Likewise.
Good to see you. So you, before this interview, you sent us some recent portfolio changes, both in your Aussie shares SMA and your small caps
Well, you
fund.
asked for them. That's what you said you
Yeah,
wanted. You're acting surprised. Like
You
I'm
said it.
just randomly sending you out my IP.
All right, well, just feel free to send them whenever you want. But we want to sort of go through both of them and unpack how you're thinking about the year ahead and some of the changes you make.
Sure.
So let's start with the Aussie shares SMA, and let's start with the macro. How much, or how are you thinking about the macro, and how much do you think about macro when making some of these decisions?
Think about a lot, act on not so much. So like, yes, it's interesting to talk about rates or yields and whatever, but and yes, it does impact stocks. I think forecasting macro is a bit of a fool's errand. You just want to be able to adapt to the prevailing environment and kind of understand the stocks that you own, the sensitivities they have in the sort of to macro sort of news flow or changes. But yeah, I think if you're worried about sales being soft or margins getting squeezed at a particular company, it's really like just margin of safety valuation work that will protect you. And it doesn't insulate you permanently, it doesn't make you, it's not perfect, you can still get whacked, don't get me wrong, but it helps you lose less money, hopefully, in the aggregate. So I think the only example I can think of is, say, like in resources, like we don't really know where the gold price is going to go. And like last year, you could have been like every other fund manager and bought, some low cost, high margin, high scale producer, who's been around for ages. Yeah, they might be growing production a bit, or, they might be looking for some cost efficiencies, but you're going to pay a high valuation for those businesses. And realistically, you're just going to get some 90% correlation to the gold price is what your share price is going to be. Whereas you can buy something that's got maybe some more takeover appeal, like we didn't buy De Grey, you still get the 90% correlation to the gold price. But if the gold price does fall, it's an asset that someone's going to want to buy. And sure enough, the gold price didn't fall, but someone wanted to buy the asset. They took it over. And I suppose those sort of strategic type thoughts, that maybe that second order thinking is, I suppose, how we like to play the various macro themes that are going on in the market, and do that with a bit of a margin of safety. So no, we don't sort of not think about it. It is thought about, but I'm not like, I think that bond yields are going to go up this year, so therefore I'm going to go and buy insurance companies. Like, that's not how we invest.
Yeah. Speaking of macro themes, are there any that you have your eye on for 2025?
Yeah, yes and no. The biggest macro themes are always the things that are happening with investors and the things that are happening with people. It's less interesting to me to say, this market's going to outperform this market, or, this asset class is going to outperform. Like, if you think you can do that consistently, you don't need to listen to Equity Mates. You don't listen to me ranting on, like, good luck to you. You probably won't be able to do it accurately if history's anything to go by, but all power to you. I think the US is too expensive. So I think it makes sense not to sell all your US equities and just go and buy Chinese equities. It's not what I'm saying. But you can maybe like tilt your portfolio a little bit more towards, emerging markets. I think everyone's talking about, large versus smalls. I think that's sort of almost a consensus call now to say that smalls are going to outperform this year. They kicked us last year. I mean, so I think it's only a matter of time for that to continue. A bit of momentum there. Europe, resources over industrials. I think boring companies like unsexy value type ideas are kind of good at the moment. In fixed income, essentially just everything ex-US. And I think probably we'll have some volatility this year. So I think like your hedge fund style, absolute return strategies, equity market neutral strategies, trend following, CTA type strategies will do well. So I think you need an allocation to those. But yeah, essentially, if you're addicted to tech, if you're addicted to the US, if you've made all your money in NVIDIA and I don't know, insert here, Bryce.
You can name another tech company.
Bryce company XYZ that he's always rattling on about. He's got 66% of his portfolio invested in it. So yeah, one of those ones, probably the ones that you own. Sell those and buy something better.
Nice.
Well, let's get to the individual stocks. So in the Aussie shares SMA, there was 6 buys and 5 sells.
Yeah.
Before we get to the specific names, how do you think about frequency of portfolio turnover? And is there any overarching strategy, or is it completely idiosyncratic on when a company is right to be bought or sold basis?
Yeah, like we look at the portfolio every day. So we're trying to find and own like the portfolio with the highest expected return that we can within the constraints of the mandate, based on all the information that we have at the time. So everything gets reviewed every day. Now, fortunately for us, that doesn't result in us trading every day, and probably our portfolios are relatively low turnover in there for their relative asset classes. I think in the large cap, it'd be like 30%, 35%, something like that. In the small cap, it might be closer to 45%. But that being said, we're getting big inflows for both, so that changes. You have to trade, so because you're constantly buying drives up your turnover. So yeah, frequency. No, I don't think about it. I think if you're trying to run stocks, if you're not running them every day, you're making a mistake. You're not doing it properly. So you need to do it every day. And probably if you're running like a multi-manager strategy monthly, it's fine. Yeah, that's about it. But your asset allocation broadly shouldn't change. If you're 70% growth assets and 30% defensive assets, well, it should roughly probably be there or thereabouts. And if you get scared, you're probably going to trade at the wrong time anyway. So you might as well just leave it alone and just worry about the minutia a bit more.
So let's start with the buyers. What are some of the positions that you have just super high conviction in at the moment?
Yeah, I hate high conviction, Bryce. It's my, it's a pet.
What are your biggest weights? I think
it's a pet peeve of mine. Because
do you think Luke ever has low conviction?
Yeah, exactly.
There is no high conviction at Seneca.
There
is just conviction or no conviction. It's a binary. It's not a.
It would be funny.
It's not some spectrum.
We should.
It's not like my various tisms. It's not.
We don't have favourites.
No, we try not to.
We should launch a series low conviction calls, and we get fund managers on to give us their lowest conviction call.
We're not sure. I bet that I can guarantee there's got to be one in there that you feel least confident with versus the others.
No.
Bullshit.
Okay, so it's a threshold, right? So if I'm feeling least confident on it, it would have a higher margin of safety to my valuation, right? So you can have something that's lower probability but a higher expected return. You can have a lower expected return that's higher probability. They both on a weighted probability basis end up at the same point, right? So it is a threshold. Now, we are not that quantitative. It's not that's not how we build a portfolio. But by the same token, we are thinking about how likely something is to happen, and if it was to happen, what kind of payoff can we expect? And if it didn't happen, what kind of negative payoff can we expect? And so it's a balance. So as much as is sexy marketing to roll around being like, my 3 high conviction picks are, like it doesn't it's fugazi, it's for you guys, it's for the punters, it is to make you buy my product, right? So it's to get your attention and to rip your eyes out. So that is what we're here to do. Nice. We're here to sell a product.
Give us a name.
Hold on. I can't wait to call this episode Luke's highest conviction picks.
6 high conviction picks.
What's your highest probability weighted expected return?
All right, so let's do 4 from large cap because you asked me about them. Okay, so the 4 stocks are Megaport, SIQ, Karoon, and Ampol, ALD. So SIQ and Karoon are both just strong cash flow, high dividend, good reasonable dividend growth and earnings growth with like a macro factor that is kind of we're sort of semi-positive on medium long term, have no timing on when that will happen, if that will happen today, tomorrow, next week. So we get this sort of decent business that we can buy for a really good price that if stuff works out for us, we could make a lot of money. So they're kind of in the same bucket. One's the oil price and one's kind of the, car leasing, novated leasing market essentially, and how much EV credits they get and the government policies around that and the tax credits and the blah, blah, blahs.
Yeah, okay. So let's hold on Karoon quickly, oil producers. So do you have a view on the oil price, or is it just...
No, we don't have a view on the oil
yeah.
price, right? We have a view that Karoon's assets are undervalued by the market, that their production history has been a bit spotty, and that's improving, and they're improving operationally, I suppose, which is really important. They've invested a lot of money to get where they are, and now the assets are starting to produce, consistently and regularly, and we think it's a very highly leveraged way to play the oil price.
So that's Karoon, KAR, and Smart Group, SIQ. You mentioned Ampol and Megaport.
Yeah. Okay, so Ampol's another one with like a backstop. This is like a...
it's the ultimate backstop.
It's the ultimate backstop, right? It's the guy with the money printer. So the government. So when they don't make enough money, essentially the government bails them out. So that's pretty much how refining works in Australia.
Yeah. So that for people who are unfamiliar, there's like 2 oil refineries left on shore.
Yeah.
Viva owns one and then Ampol owns the other one, and the government need them in operation for like national security purposes. Yeah.
Essentially, right? So everyone, and when I say everyone, like all the fund manager, talking heads are all excited about Viva, and like now Ampol's 20% cheaper than Viva. We think they're just the same drivers. You want to own them both. They're not that different in quality, so they shouldn't. That valuation gap should close.
Are there other parts of the business that are different between the two? Like obviously everyone got excited by the On the Run acquisition.
Yeah, and the retail and the margins and they're spending longer because of EV charging at the servo. Like, there's all the there's all the things, right? Like but they're the same essentially, right? Okay, yes, one might be first, another one's going to be second or whatever, and but the net here is the quality between the two businesses isn't different. We're not talking about REA and Domain here. The main driver is that refining margin. It impacts both pretty equally. So that's that.
Interesting.
Megaport's a little bit unique. Everyone owned it, as you guys probably can remember. It was they owned it for the fast growth and all of the fugazi that you guys rattle on about structural tailwinds and other rubbish that everyone talks about means nothing. And then they dumped it. And they dumped it hard, unceremoniously, because it was unprofitable all of a sudden. Everyone changed their mind, and unprofitable growth was now, instead of being the flavour of the month, it was now in the bin. So we've bought it because now it's more profitable than ever, and it's still growing quite well every quarter. So
and there's some nice structural tailwinds behind it as well.
Forget about it. Look,
doesn't matter.
It's positive free cash flow. There is decent tailwinds, but they've got cost levers to pull as well. I think this has probably been my pick for reporting season. If you were going to have a punt on a day, expectations here are in the bin. So, and today's only making it worse with the deep sea China AI. Everyone's fretting about everything, right? So, they'll be wrong, and hopefully we'll be right.
Nice. Okay, keep an eye on that one. And then finally, one that you mentioned earlier in the show is DeGray, DEG.
Yeah, so that's under takeover now from Northern Star. I think the price is like 206 and the stock's trading at like 2. So there was like a good little window there where we could have played a nice little arb game. And our thesis late last year post takeover was there would be a second bid, and it would be like a higher script bid with like a cash component. It hasn't eventuated like that yet, and it's my call, and I sort of said, I think that's what's going to happen. Ben was a bit more dubious on it, as usual. Ben's right. So we're happy to be a Northern Star shareholder, and we're happy to take the gold exposure, sort of as I was explaining before. But, if you've got other ideas, like put it this way, as soon as something else comes up that I want to buy and go hard at, well, I've got one good funding source there, right? At the moment, it's kind of going okay for us. We don't really have any issues, and I don't think Northern Star is going to fall out of bed anytime soon. But that's DeGray. So that's been a really big winner for us last year.
Nice.
So let's turn to some of the sells, because there's some interesting names here, and I reckon one that's been a darling of a number of retail investor portfolio's and certainly a number of retail investor kitchens is Breville Group.
Make a good coffee machine, they do.
They do. Yeah, BRG, it's been an Australian success story taking on the world. great growth numbers in America and Europe.
Our team there again. What's going on here? Are they sponsoring the podcast now or something?
We've never taken a cent from Breville, but I'd love to.
You should start taking more than a cent from them.
But, you know, it's an Aussie success story taking on the world. We don't get enough Aussie success stories doing it well overseas. But you have exited your position there.
Yeah, and it's probably, well, it is. It's the first time kind of ever that I've sold this stock. So even when I didn't have a product, even before we ran the fund and I was running individual portfolios for clients, which I still do, you know, if you've got enough money, I'm sure I'll do it for you. I wrote a paper on it for uni. Like, it's been part of Luke giving clients advice and making money for people since as long as I can remember. But it's the perfect example of what I'm always trying to bang on to you guys and bang on to Equity Mates about is valuation discipline. Like, I love the company, I love what they're doing, love the product, love the way they run it. They've got the geographic expansion story still rolling. It's all, there's no issue here, but it's not worth 40 times earnings in a global economy that's decelerating from a growth perspective. And the worst part of that, really, for be on a delta adjusted basis, is Europe. So I would argue that's where they're going to get their incremental growth that's unpriced from. And a lot of that is now in the price at 40 times earnings. So like, we will own it again. I'll own it after a downgrade. I'll own it after something falls out of bed for a reason. But if I don't, you know, that's fine. You know, we've done really, really well out of it. And I'd be happy to buy it if the earnings grow and it all works out and, you know, it makes sense for us to do it again because of some growth driver we can't see. That's fine. I'll pay up for it and off we go again, you know.
Yeah. So one other sell, Luke, a notable name, IDP Education, IEL, the ticker.
Yeah.
Do you want to talk to that one?
Oh, it's kind of just one of those ones where we had a thesis and we realised our thesis ain't going to work. So we just cut it. So we bought it quite well. Again, margin of safety. So we kind of got out of jail there and made a little bit of money, but it's not something I want to be bragging about. The issue there is essentially we thought, okay, well, there'll be some sort of return to international students and migration. But I think, you know, the government policy and certainly the way things are playing out in other parts of the world, which matter to IDP, that's not really going to happen at the speed we probably would want it to happen. It's a decent stock. It's historically been, you know, relatively high quality stock. It's the kind of stock like, you know, the punters out there will go on the ROIC screen and pull up, you know what I mean? Like, and it'd be like, oh, it's got a high return on invested capital. I must own it. And you know, and so like it works on those kind of metrics, but it's a business that's kind of been disrupted by the governments of various developed economies where people want to go and study. They're kind of dominant at what they do, but when you're dominant at what you do, it also means you're always exposed to the government. So look, there'll be a day for that, but it's not today, so we flipped it.
Nice. Well, Luke, we're going to take a quick break and on the other side dive into the small caps fund and what you've been buying and selling there. So we'll be right back. Welcome back to Equity Mates. We're here with Luke Laretive from Seneca Financial Solutions. Now, a reminder that if you've just joined us for the first time, Luke has a subscription service called Good Research. You can head to goodresearch.com.au where twice a month he will send you, or him and Ben will send you a stock that they are looking at and a bit of a write-up as well. You can use the code MATES for 10% off. There's a monthly or an annual subscription there. So go and check it out and you'll get all the reporting that we're talking about at the moment, all the buys and sells. We'll put a link in the show notes. Now let's move to small caps, Luke. A number of the big investment banks have been calling 2025 the year of the small caps, or that they're going to outperform the large. Do you agree with this?
Yeah, but I mean, it's like asking me, do I agree the sky's blue or, you know, the grass is green? Like, it's kind of
yes every year.
A lot of years, smalls haven't outperformed large.
Yeah, if you look at it on an ETF basis, sure. You know, so I think that...
How else would you look at it?
Yeah.
Luke's 5 stock picks versus...
What I'm trying to get at there, I suppose, is that your metrics are a bit flawed, right? Like the index calculation for, you know, smalls, you guys have talked about it before, you know, I've talked about it a lot. So, you know, if that's your metric for like how you evaluate historical performance, like for small caps, it's going to be stuffed. So what you really need to do is remember that over the last, there was a thing from Morningstar, put that in the show notes, the Morningstar thing I sent you guys, but it's like, I don't know, like 75% of Australian small cap fund managers have beat the small cap index over 10 years.
Yeah.
So what's that tell you? We're not getting any smarter. It tells you that, that the index is flawed. So if that's the case, I would argue that, you need to take a peer group average of the active managers in the market and compare that to maybe the large cap index and say, okay, well, how is that tracked large relative to smalls?
Is that what you benchmark yourself on?
Yeah, so we always look at our peer groups, right? So we want to always be, a top quartile manager, and that's kind of our goal. And to be fair, both products, they were designed in exactly the same process, which is, okay, what does a top quartile manager in this particular corner of the market look like? And can we improve on what the average manager in that top quartile is doing? And there's, various advantages we think we have over our competitors. And our pricing is there designed to be able to, be part of that, be competitive, I suppose, in each of those top quartiles. So we fully expect it in 10 years to be, a top quartile manager in both asset classes. And we've got a strategy designed to achieve that. Now, will it work every year? No. Will it work every 3 years? Maybe not. But, we think that, history shows that these sort of strategies, this is what they do.
Yeah.
So I think a lot of people go out there trying to design a fund based on I'm so smart, watch me, throw darts at the dartboard. I think that's just so naive. It's just backwards. So
nice. Well, fighting words from Luke. Now, at the end of last year, you and Ben wrote a piece on Livewire talking about how 2025 is going to be the year for M&A.
I hope so.
What's the thinking there?
I'm looking for a big bid for Seneca Financial Solutions, so you can email me. Look, it's the same reason M&A has ramped up in the past. This is not some sort of, I'm having some divine intervention where Jesus has told me that, M&A is going to kick off this year. There's a lack or reducing number of organic growth opportunities in a range of sectors. There's underutilized sort of high upfront CapEx assets that are sitting around with capacity. You've got greedy management teams who want to meet their KPIs but can't because there's not enough growth around to scratch it together, and they know it. And, there's probably going to be at some point, not quite right now, but a declining cost of capital. Bond yields are going to go down. Maybe rates will follow bond yields, 3-6 months typically afterwards. So, we're going to see lower inflation, which is kind of reducing the cost of capital a little bit. So, yeah, I just think it's a reasonably good environment. And if you throw all those factors together in almost any period through history, you would see a tick up in M&A.
Now, we've got a number of buys and sells from the fund here. So let's go through some of the buys. Not high conviction, just buy. Let's start with Antipa.
Only conviction at Seneca. Only conviction. Yes. That's kind of your tagline.
Antipa.
Seneca, only conviction.
Only conviction. AZY. What does it do, and what's the thesis?
Okay, so it owns this 2.3 million ounce gold deposit, Minyari Dome. But you don't care about that. The main thing that you care about is, well, you do, but you don't. Is there's a big mill down the road that's owned by Greatland Gold, attached to Telfer, which is another big gold deposit, and it's massively underutilized and it needs feed. So it's only logical that the company Greatland Gold would try and acquire Antipa. We think that happens in the first half, and we think it can go for I think it's it was 2 cents, it's now 3 cents, but it might be a 5 or 6 cent deal. So might be some script cash, whatever, but yeah, it's that's going to go.
Okay.
How long do you wait on this for? If it hadn't happened in the next 12 months, do you still sit on it, or
I don't know. If it hasn't happened in the next 12 months, then your thesis is wrong, and you're wondering, well, why haven't they bought it? Why haven't they bought it? There's something I don't know, or you're just being impatient, and there's other reasons why they haven't bought it that have got nothing to do with you or Antipa. Look, I don't think you should think about it like that. I think the most important thing when you're looking for takeover opportunities or looking at takeover opportunities is what do you get in the interim? And what you get here in the interim is a gold project that's progressing, that's passed, that's capped, it's got money, it's not going to need to raise. They just took money at the end of last year to get them through, so that pretty much get them through to a bid essentially, so that they're not like gun to head, sort of, exactly. So, smart from the management team. Yeah, you just get gold price exposure kind of in the interim. So like not the worst. It's kind of like a mini DeGray 2.0. This is kind of, I don't know anyone else who makes these kind of calls publicly and does stuff like this. So this is what we do. This is our go, right?
So like, because it's reminding me, so DeGray was another one where you were thinking about the takeover opportunity, but then Oz Minerals last year, you were also thinking about the takeover opportunity there, and you were right. So how?
Rarely.
So
very occasionally.
What are you analysing that others aren't, or like what's your process to think about these potential takeover opportunities?
Yeah, I can only say it's just from being a bit of a practitioner, like working in the industry. I worked in the sort of marketing and strategy part of the business at Vale. So probably you just know what to look for. You kind of have some understanding of how big mining companies think. And how, when I say think, I mean as an organisation, like sort of, organisational thinking, and how they handle problems and how they look for opportunities and what's appealing and what's not. Yeah, you can do the math. I mean, Antipa is not a secret. Like, that's, people know. I think a lot of fund managers also try and get cute sometimes and like, I'll buy it later. And then you would have bought DeGray later and you're too late. You know what I mean? You would have bought Oz later and you're too late. So I think you can get a bit cute with stuff like this as well. Some people it's going to be too small as well. Like it's, might not be able to get in and out of it in size if you're a, $500 million or $1 billion small cap fund. But yeah, look, I think it's pretty well owned. It's certainly not Luke out on a limb here. And yeah, it's not rocket science, that one.
Okay.
So how about some of the other buys? Any that you think are particularly notable, or?
Well, like if you want to stay on takeovers that I think are pretty likely, like Wildcat, which, we've written for good research. Wildcat's going to go this year in my view. Again, another one with cash. You can't hold a gun to there. They got $65 million in cash with about 10 to spend. So like there's no issues on cap raising there. Pilbara got to buy it. They just closed that LRS deal over in Brazil. You stack LRS up against Wildcat, you'd be like, should have just bought Wildcat. It shouldn't have gone off running over to Brazil. You could have bought 145 Ks down the road. Yeah. It's better. Don't have to go and build a whole other plant over there. Like it's sort of a bit crazy. They've word on the street is they've been sticking a few drill holes into Pilgangoora North and East and not getting much success. You've got a nice resource just down the road. It's thick, sort of got all the right characteristics. I won't do the mining rant, but essentially would fit beautifully into what they're trying to do, allow them to process more of the Pilgangoora ore through the ore sorters, which is utilises the stratified ore better, and they can do this thick stuff just the old school way, which would better utilise their kind of investment they've made in their own business. So Pilbara need to consolidate the Pilbara. They need to consolidate spodumene in WA and get to scale, like a big scale quickly to be competitive with brines and what we're calling the brine cartel, which is, the sort of the Rio, SQM, Albemarle, South American crew who are kind of what we think becoming like OPEC 2.0 for lithium.
Really? Okay.
Okay. Interesting.
So one other buy that you've been you've spoken about before, GQG Partners, the fund manager based in Miami but listed in Australia.
Boutique.
Yeah. You added to your position as they were falling. They've had some controversy over shareholding in the Adani companies and in Novo Nordisk. You think those are overblown?
Yeah, I mean, Novo was up.
Yeah, I know.
Big last night, right?
This new drug is crazy.
It sounds sick, right?
Yeah.
So I think I'm going to get on it. So it's look, I don't know much about drugs and I don't know much about Novo, and I don't pretend to be a guru on any of that sort of stuff. It's not my go. However, GQG are good at that stuff. They're really, really good at it. And yeah, I just wouldn't be caught up in the noise and the hype here for us. That's our sort of view. All active managers underperform for periods of time. You might take your money off them because you're a punter at home who doesn't know any better. But if you're a serious asset allocator globally, whether it's a sovereign wealth fund or just a big kind of asset consultant type sort of thing, you're not swinging at something for a quarter to a year, 2 years of underperformance. It's just not how people with real money to allocate go, if you know what I mean. So they've had some small outflows in December. We think that's going to be corrected at probably within a quarter, and wouldn't be surprised if GQG put out some good numbers. They were ahead of benchmark in both products to 31 December. We talked about it in investment committee this month because we're invested in both. We are not perturbed by, short-term get a stock call wrong. And in fact, go look at the Adani share price and the defense kind of rests, right? Like that's up as well. So you don't have to be I just think it's just massive hype. And people in Australia, we love like sniping fund managers. I don't know. It's the Magellan effect. It's the Magellan effect.
Everyone's once bitten, twice shy.
Caledonia thing, like they're always
Platinum as well. Platinum, that was hyped and then,
Yeah, and it's like, they underperform, they charge heaps for fees and they're all billionaires. Well, that's sort of true. Like it is true.
Well, it is true.
It is true. It's true. It's true to an extent, but there are exceptions to those that common thinking or that so-called fact. And certainly there are heaps of good managers who, whether they're billionaires or not, who really cares. They're certainly not bad investors. That's for sure. So yeah.
Well, look, on the sell side, just a couple to close out. You sold Webjet.
Yep. We did. Yeah, we did sell Webjet.
Any reason?
Sounds like you almost forgot you sold that.
Yeah, I was like, did we? No, I was like, no, we did. Okay, so in the smalls, it's probably a bit of tax management. So we were forced realisers of our global data centre position, which kind of effectively got taken over. And when they sold their 1% stake in AirTrunk, which we talked about probably 2 or 3 podcasts ago with you guys, we were forced realised from Mermaid Marine. In this financial year, we were a forced seller we're going to be a forced seller of De Grey at some point. So, these are sort of tax gains for the trust. And we had a loss there in Webjet that we could take. So we did. And we're kind of revisiting Webjet now. Oh, nice. So thinking about it again and... all the changes I sent you were to 30 December. Yeah. So maybe they're not all quite up to date.
Okay. So how do you, with that caveat in mind, how do you think about the demerger of Webjet? Is there one side of the bet that you'd rather take?
I think they've both got appeal, right? So, there's this Spanish IPO, this hotel beds thing that's going up on a pretty spicy val, and WebBeds is better and bigger. There's a heap of these bed banks around that I think they either consolidate or the industry's growing so quickly and they're all doing 30% growth that no one needs to do anything. I don't really see a scenario where you don't win, and if you are the second biggest player and there's 6 competitors, if you were the biggest player or the third biggest player, like you guys should be, getting together and talking dirty because there's no real... no one else really is going to play with you if you can get to that position, and certainly because they're global businesses, you're not really going to get like ACCC type antitrust type issues because it's global, right? Like, and there's just heaps and heaps and heaps of places you can go to organise bulk hotel beds. So that's the web side. WJL side, I think that's probably more of a takeover angle that could be rolled into anything. Like there's literally 15 ways you can skin that. Don't know how that business is performing. I don't really have a view on that at the moment. I think Web's going better and tracking towards what their stated FY26 and longer term margin and volume kind of goals are. Market's kind of under those numbers from a consensus level. In fact, they're under kind of what I think a reasonable guess could be. So I think Webjet could be good, Web Travel Group or Web WEB.
Yeah, the web beds.
The B2B one could be good in reporting season.
Yeah.
I think if I was going to have another decent swing at it, I'd probably just wait and just wait for the facts to see the facts.
Nice one.
We appreciate you jumping on. A reminder that if people want more of Luke's picks, goodresearch.com.au, use the code MATES for 10% off either a monthly or an annual subscription to in-depth research reports a month. Some of the companies that we've spoken about today have previously been featured. But Luke, thanks for jumping on.
Pleasure, gentlemen.
And if you're interested in actually getting in either of the funds that Luke runs, head to equitymates.com/advice and we'll connect you with Luke.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.